Hey everyone, welcome back to Corporate Decoder, the place where we unlock the secrets hidden within company filings. Today we're diving into Worthington Steel Incorporated's latest quarterly report. It looks like they've been busy, and we're going to break down what all those numbers actually mean for the company's future. Before we jump in, if you want more straightforward insights from these financial documents, make sure you are subscribed. And hey, join our Discord community by checking the link in the description below. We're building a great community to discuss these things further. Worthington Steel Incorporated, a major player in North America, S-Value Added Metals Processing, has just dropped its quarterly report for the period ending the 31st of August, 2025. Think of them as the folks who take raw steel coils and shape them precisely for industries like automotive, construction, and energy. It is a big business with complex operations, and this report gives us a look under the hood. Let us start with what they own and what they owe. As of the 31st of August 2025, Worthington Steel had total assets of a little over $2.2 billion. That is up from about $1.96 billion back in May. On the flip side, they owe a substantial amount too. Their total liabilities are up to $912 million from $763 million. This increase in liabilities seems to be largely driven by new debt and the acquisition of the Accession Group, which we touch on later. Now, onto the money they're remaking for the 3 months ending the 31st of August 2025. Worthington Steel brought in $872.9 million in net sales. That is a nice jump from $834 million during the same period last year. This growth is a good sign despite a slight overall decrease in the total volume of steel processed. What is really interesting is their gross margin. It went up quite a bit, reaching $115.2 million or 13.2% of net sales. Last year, it was $100.4 million, representing 12% of sales. This improvement is significant. A big part of this seems to be how they're rehandling their inventory. They experienced an inventory holding gain this period, which helped offset losses from the previous year. Essentially, the price of steel went up in a way that benefited them this quarter, which is not always the case. However, their operating costs, known as selling general and administrative expenses, also rose considerably. They went from $57 million last year to $67.9 million this year. A big chunk of this increase, about $7.9 million, comes from the recently acquired Accession Group, which includes a one-time bonus payment. This acquisition is clearly impacting their expenses, even as it contributes to sales. Interestingly, they reported a small income. $1.0 million from restructuring and other activities. This was mainly due to the gain from selling some assets as they consolidate a facility. It shows they are actively managing their operations, sometimes by selling off parts that are no longer strategic. Their investment in an unconsolidated affiliate, Serviesro Worthington, really boosted their earnings. This investment brought in $6.4 million this quarter, a big jump from just $1.3 million last year. This highlights the importance of their partnerships and how well those are performing. When it comes to taxes, things got more expensive. Income tax expense jumped from $4 million last year to $13.4 million this year. This is largely due to the higher pre-tax earnings, but also because last year they benefited from a special tax adjustment. To get a clearer picture of their core business performance, they look at something called adjusted EBIT, which tries to strip out one-time or unusual items. This adjusted figure rose from $39.4 million last year to $54.9 million this year. This jump is mainly thanks to that improved gross margin we discussed, plus income from their investments. Now let us look at how they're regenerating cash. For the 3 months ending the 31st of August 2025, they actually used $6.3 million in cash from operations. This is quite a shift from the same period last year when they generated $54.6 million. This change is largely because they needed more money to fund their working capital, meaning they had more money tied up in things like inventory and money owed to them by customers, partly due to higher steel prices. In terms of investing in the future, they used $29.6 million. A big part of that $29.4 million went into property, plant, and equipment. This suggests they are investing in their facilities and production capabilities. They also spent $1.6 million on acquisitions, specifically the Accession Group purchase. Financing activities provided them with $21 million this quarter, a big turnaround from the $37.3 million they used last year. This positive swing is largely due to borrowing more money. They took on new debt, including from the BDC loan and their revolving credit facility. They also paid out $8.1 million in dividends, showing they are returning some value to shareholders. Speaking of borrowing, their revolving credit facility is a significant source of liquidity. As of the end of August 2025, they had $160 million drawn, with almost $280 million still available. This facility is secured by their accounts receivable and inventory, which is a common practice. They've also secured some interesting government-backed loans for their Canadian operations, like the FedDev loan and the BDC loan, specifically to fund expansion and construction projects. These loans often come with favourable terms, which is a smart way to finance growth. The acquisition of the Citon Group brought with it a number of its own term loans totaling about $48.8 million. These loans have various maturities and interest rates, adding complexity to their debt structure. When we look at the fair value measurements, a lot of their derivative financial instruments, like those used for managing commodity and currency risks, are valued using level 2 inputs. This means they rely on observable market data, which is generally considered reliable. There were $2.5 million worth of derivative assets and $2.5 million worth of derivative liabilities at the end of August 2025. A new accounting policy they've introduced is related to redeemable non-controlling interest from the Citon Group acquisition. This means that minority investors have certain rights, like put options, that could require Worthington Steel to buy their remaining shares. Because these options aren't entirely within Worthington Steel's control, these interests are now placed in a mezzanine equity section on their balance sheet. This is a key detail as it represents potential future obligations. Looking at their sales by product class, direct sales, where they own the steel, made up the bulk at about $839.5 million, while toll processing, where they process customer, owned steel, brought in $33.4 million for the quarter. This shows their primary focus remains on processing and selling their own inventory. In terms of their business segments, Worthington Steel operates as a single reportable segment. This means their chief operating decision maker, the CEO, looks at the entire company's performance as a whole, which simplifies how they manage and report their operations. Their sales are significantly tied to the automotive industry, making up 56% of their sales in this quarter. The Detroit 3 automakers alone account for 35% of their total sales. This concentration highlights both an opportunity and a risk. A downturn in the auto sector could hit them hard. They also highlight sales to customer A and customer B from the automotive sector, each making up a notable percentage of their revenue. Their raw material costs, particularly for steel, are crucial. The price of hot-rolled steel, a key commodity they use, was $857 per ton on average in the first quarter of fiscal 2026. This is a significant increase from $690 per ton in the prior year S quarter, and it directly impacts their cost of goods sold. So, what is the bottom line for the shareholders after all this? Net earnings attributable to Worthington Steel shareholders were $36.3 million for the quarter. That is up from $28.4 million last year. When you factor in the number of shares, earnings per diluted share came in at 72 cents, up from 56 cents last year. This is a positive trend for investors. Now, my take on all this: Worthington Steel is clearly navigating a complex environment. The Citon Group acquisition is a major move, boosting their sales and market share, especially in Europe, but you can see it also increased their expenses and brought in new debt. Their improved gross margin, driven partly by favourable inventory accounting, is a welcome development, but the dip in operating cash flow is a concern. It tells us that while they're remaking money on paper, they're reholding onto more cash in their operations, which can sometimes signal a slowdown or the need for more working capital. They are investing in new equipment and facilities, which is generally a good sign for future growth, especially in areas like electrical steel for the transformer market. The reliance on the automotive sector remains a key risk factor, as does the volatility of steel prices. Overall, Worthington Steel appears to be strategically repositioning itself through acquisitions and investments, and their financial results for this quarter show some positive momentum, particularly in profitability. However, they need to manage their increased debt levels and the cash tied up in operations carefully. The integration of Citon Group will be crucial to watch, as will their ability to diversify their customer base beyond the automotive industry. Alright, that is our deep dive into Worthington Steel. As latest report, what are your thoughts on these numbers and what they mean for the company? As path forward, let us know your opinions in the comments below. If you found this analysis helpful, please hit that like button and subscribe for more in-depth corporate breakdowns. And once again, don't forget to join our Discord community linked in the description. Thanks for watching Corporate Decoder. See you next time.